All right, guys. I hope you are as excited to start this subject with me as I am to start it with you. So let's dive into the subject. Now, how will we proceed further is that during the course of this subject, I will make you an auditor, right? I know that you are not an auditor right now, but I will prepare some practical, situations wherein you will be feeling that I am the auditor, and you will be actually auditing. We'll take up some examples. We'll probably take up Amazon and start auditing it. All right. So with this information, let's dive into the very first chapter, which is the introduction to assurance. All right. Now, before we begin with the technicalities to this, there are two terms. And of course, before I start to write something down, I hope you remember your promise. You will be interacting with me. Now, I know your obvious question. You might be thinking, Ayush, you are on a recorded video. Please don't be silly. How can I interact with you? You can. So, how will we proceed is at various places, I will be taking a pause. All right, I will be asking a question and be taking a pause. And you will be framing an answer in your mind, and then I'll tell you the answer and you will match it with me. All right, that's the best what we can do offline, right? Okay, now there are two terms here. First is audit. So the first is audit, and the second is assurance. Now you need to tell me the very first question coming your way is which is a broader term? Is it the audit or is it the assurance? Which do you think is a broader term? Now, most of you might be saying it correctly that assurance is a broader term and audit is just a part of assurance. All right. So, assurance is a much wider definition, and audit is a part of assurance. All right. Then let's begin. Now, when we talk about assurance, I know there might be a question in your mind that fine, off and on, I know what exactly is assurance, but I'm not aware about a technical definition to it. Can you please explain it to me? I'll be very happy to. So, the first question, what exactly is assurance? What is assurance? Guys, it'll be very beneficial for you if you start writing down everything that I am also writing, because you'll notice that we will be covering this entire subject in the form of quick flowcharts, and you'll be amazed how easy it will be for you to remember and understand the concepts in the form of flowcharts. All right. Wherever possible, I will be giving you some mnemonics to understand where there will be multiple pointers for you. Okay. So, what is assurance? Now, learn it this way. Assurance is something that helps me answer four W's. No, you don't need to write it in the exam. This is just for your understanding, all right? Assurance is an engagement which helps me answer four W's, right? So, assurance, the first one. What is assurance? Assurance is an engagement. Assurance is an engagement in which what happens? Four W's coming your way. So, assurance is an engagement with four W's. First, who does that? A practitioner. I am specifically not calling it auditor because assurance is a much broader term and audit is just a part of assurance. So, when we're talking about assurance in general, we will be denoting the person as a practitioner. Okay. So what is assurance? It is an engagement in which a practitioner, right? You'll notice that this definition after the next 2-3 minutes will be on your tips. Assurance is an engagement in which a practitioner, now the remaining three W's coming your way, does what? It's fine. It's done by the practitioner, but what is to be done? So, in which the practitioner obtains, now obtains what? Sufficient and appropriate, in which a practitioner obtains sufficient and appropriate evidence. Let's call it as audit evidence, appropriate audit evidence, right? So, what is the definition till now looks like? Assurance is an engagement in which a practitioner obtains sufficient and appropriate evidence. So, who does that? Practitioner. What does he do? He obtains sufficient and appropriate audit evidence. Why does he need to do that? The next W. Why? So, why is it done? To express a conclusion. To express a conclusion. And what will this conclusion do? What will this conclusion do? It enhances the degree of confidence. Don't bother, guys. Don't worry. I will be explaining it in a bit. All right. Just try and write this down. So, assurance is an engagement in which a practitioner does what? Obtains sufficient and appropriate audit evidence. Why? To express a conclusion. He gives a conclusion. And what does that conclusion do? It enhances the degree of confidence. It enhances the degree of confidence. Now, degree of confidence of whom? The next W. For whom? Intended users. The degree of confidence of the intended users. All right. So, what is the definition of assurance? Assurance is an engagement in which a practitioner does what? Obtains sufficient and appropriate audit evidence. Why? To express a conclusion to enhance the degree of confidence of whom? The intended users. All right. Now, I know the question in your mind right now. What do we mean by sufficient and appropriate? This term here, what do we mean by it? Then, why is there a need to express a conclusion? And who are the intended users? Right? You might be having these three questions in your mind. Let's go on and answer it one by one. Now, consider yourself. Now, consider yourself as an investor, right? You are planning to purchase a share of Amazon, right? So you are planning to purchase a share of Amazon. Okay. So you are planning to purchase a share of Amazon. Now, before you purchase the share of a company, you generally look at. So you are planning, you are an investor, you are an informed investor, right? Now you will look at the financial statements of Amazon to understand that how has the company been performing over the years? Does it have a good performance or is it in losses? Will you get a good return on that? How will you get all this information from the financial statements? Yes. So from the financial statements, you will be getting this information. Now, my next question to you, who prepares the financial statement? Is it the auditor preparing the financial statement, or is it the management of the company to prepare the financial statements? Guys, most of the people have a wrong understanding of this. So I generally interact with a lot of students before they start their journey to the audit subject. And general notion is that auditor and the one who prepares the financial statements is the same thing. They are the same person, right? So many people feel that the one job of an auditor is to prepare the financial statements of the company. That's not possible. Why? Because auditor reviews the financial statements. Auditor will check the financial statement. They will audit whether the company has done everything correctly or not. They are not preparing the financial statement. So if auditor is not preparing the financial statements, who is preparing the financial statements? It is the management of a company. The management prepares the financial statements. All right. So this is a very, very important aspect, guys. Financial statements are not prepared by the auditor. Financial statements are prepared by the management of a company. Okay. Back to our example. So you are an informed investor and you check the financial statements. Now, in this financial statement, so if you have tried looking to the annual report that gets published to the investors, now they have the financial statements which is audited, right? So there, the auditor might be EY, and they might be signing off on those financial statements on the auditor's report, right? So this means that the financial statements are audited. Now, what will happen if audited financial statements are not there? If the management simply gives you that, okay, these are the financial statements as per the management, will you be able to rely on that or financial statements? Yes or no? As of now, you might want to say, yes, I will rely. These are being given by the management of the company. Why will I not rely on them? But as we move forward, guys, you will never rely on that. You will rely on the financial statements which are audited. Why? Because management has various incentives to manipulate the financial statements. We will discuss it as we go forward. But understand that management has a lot of incentives to manipulate the financial statements for you. They want you to invest in their company. They want to show you a very rosy picture, right? So you will always be relying on the audited financial statements. Now, if the statements are audited, you place more reliance on them, your confidence get enhanced, right? So if auditor is writing down that I have checked all the financial statements and everything is fine, you will place more reliance, correct? Your confidence in that company enhances, and hence this answers your why question. The auditors need to express which enhances the degree of confidence of the intended users. Who is the intended user here? You. The intended users are the person who is interested in the financial position of the company, who is interested to know what is the performance been like, who is interested in the financial statements. Now, it might be investors, it might be the government. Why the government? Taxes. It might be the creditors. Why the creditors? Because they need the money back. It might be the customers. It might be the bankers. Why bank? Because you will be probably going for a loan, right? So all these intended users are also known as the stakeholders. The stakeholders. All right, so intended users, we have covered. Why is there a need to express a conclusion to which will enhance the degree of confidence? That also we have covered. Now, sufficient and appropriate evidence. Okay, now let's talk a bit about sufficient and appropriate. Of course, we will be doing it in detail going forth, but sufficient and appropriate. Now, sufficient, when I talk about, I am talking about the quantity, and appropriate, I am talking about the quality. On a very broad basis, I'll explain here, okay? Now, let's take you to an audit process, right? Let me take you to a practical battlefield of audit. So you are a very happy auditor, all right? You go to audit, let's say, Amazon, okay? And you are auditing there. Okay, you have a briefing with your manager. Your manager assigns you revenue. He says, all right, Mr. Auditor or Miss Auditor, go and audit revenue. Check whether everything in revenue is fine or not, whether management has accounted for everything or not. Right? How it is to be done, guys? Let's leave it for another chapter because I will have to build your foundation till the time you are ready to enter the battlefield. Okay. As of now, just restrict to this example that you are going to audit the revenue of Amazon. Now, we'll talk about revenue. Let's say that revenue is divided into 100 items or 100 records, right? Now, you go to the battlefield, you go to the office of Amazon, you take up the revenue files, and the management gives you 100 items saying that in this particular year there are 100 revenue entries, 100 records, 100 people for revenue, right? Now you decide to take a shortcut. You said, let me impress my manager by doing the work quickly, and out of this 100 items you check 10 items and you come back and say everything is fine. Now, the manager is very impressed. He said, perfect. How did you manage to do this in just a day? We couldn't. And you, of course, you are amateur. You say, all right, I did check 10 items. Everything was fine. The manager said, all right, what about the remaining 90 entries? And you are short of words. Now, you say, but if 10 is right, entire 90 should be right. Does that make sense, guys? Will the manager be impressed? On the very first day, what will happen? You'll get a good scolding. Why? Because the evidence that you gathered, of course, if you're checking 10 items and saying everything is right, that's your evidence, right? Evidence. You are Sherlock Holmes. You're finding out evidences, right? So if you are finding the evidences and you just check 10 items, so your evidence is not sufficient for you to say that this revenue is correct. Do you agree with me? Correct, right? Because if 10 items are correct, that does not mean that 90 items are also correct. There can be fraud in the next 20 items, which you have missed. Correct? So the evidence should be sufficient for you to have confidence that, all right, revenue is correct. Let's say there is a situation next day you went again and you checked the remaining 80 items. Now, how much testing have you done? You have checked 90 items and you have found out to be correct. Now, when you have checked 90 out of 100 items and everything is fine, then you can frame your conclusion on this, right? Then you can frame your conclusion. Now, the evidences that you have gathered is sufficient, right? Now, this is sufficiency of evidence. What is appropriateness? Now, I am saying that all the evidence that I am gathering, they should be appropriate. They should be appropriate. That means, just to give you a very broad example, that if I am checking revenue, I will be checking invoices, right? I'll be checking invoices. I'll check whether the payment has come or not, right? I will not check inventory for it, right? So if I go on checking inventories and say that revenue is fine, then my evidence is not appropriate, right? And there can also be another situation that you go to the management and you just ask that, okay, is everything going fine or not? What will the management say? Everything is going on brilliantly in the company. And you frame your opinion. Again, the evidences is not appropriate. All right. So this is what I mean when I say sufficient and appropriate audit evidence. All right, guys. So what is the definition like till now? It's that assurance is an engagement in which the practitioner does what? Obtains sufficient and appropriate audit evidence. And why does he do that? To express a conclusion. And what will happen when he expresses? That will enhance the degree of confidence of the intended users. All right. So that was the first topic for you guys. I hope you enjoyed this scenario making with me. And at the same time, you are comfortable with the definition of assurance. Now, the next topic. What are the various elements? What are the various elements of an assurance engagement? What are the various elements of assurance engagement? So here I will be mentioning the elements and I will be also giving you an example from the audit. Okay. First, the first element of an assurance engagement is that there are three parties. This is a very, very important concept, guys. Please be very careful with this. I am telling you the elements of assurance engagement. The first is that there are three parties to it. Now, if I take an example of audit, what are those three parties? There needs to be an auditor, correct? There needs to be the directors of the company, the management, right? And then there needs to be a shareholder, you as an investor, right? So there are three parties: auditor, directors of the company or the management, and the shareholders. Why these three? Because who does the audit? The auditor. For whom? The shareholders. And who is interacting? Who is managing the company? The directors. All right. Now, this is the first engagement, the first element of the assurance engagement. Second, there needs to be an appropriate subject matter. There needs to be an appropriate subject matter. Now, all right, you are doing an assurance engagement, fine. But on what subject are you doing? On what is the subject matter? So, if I give you an example of audit, what is the subject matter? It's the financial statements. It is the financial statements. All right, so three parties, appropriate subject matter. Third, sufficient and appropriate evidence. The evidence which you will gather needs to be sufficient and appropriate, right? So, as of now, we have done three elements. What are those? There are three parties. There is an appropriate subject matter involved. The evidence need to be sufficient and appropriate. So, three parties, appropriate subject matter, sufficient and appropriate evidence. Fourth, there needs to be a suitable criteria. There needs to be a suitable criteria. Now, how will you say that financial statements are correct? You are verifying against what criteria? What is the criteria that those financial statements need to fulfill? So if I give an example of audit again, now the financial statements should be prepared according to financial reporting framework. We will abbreviate it as FRF. What is the criteria against which I am giving an assurance? I am saying that financial statements are correct, but correct as to what? That they should be prepared as per the FRF, right? So that is the criteria. So four elements done till now, three parties, appropriate subject matter, sufficient and appropriate evidence, suitable criteria, and fifth, how will you give your opinion? There needs to be a written report. And in terms of audit, this is your audit report. All right. So, five elements, very important, guys. Why am I stressing so much on this? Because that's very important, and it has been in exams multiple times, right? This as an MCQ question. What are the elements? Three parties, appropriate subject matter, sufficient and appropriate evidence, suitable criteria, and written report. All right. So I hope this concept is clear, guys. Okay. So we have covered what assurance is. We have also looked at the elements. Now, let me give you a brief about the types of assurance. Types of assurance. Now, there are two types, right? Two types of assurances. One is your reasonable assurance. Reasonable assurance. And second is your limited assurance, right? So reasonable assurance and limited assurance. Now, audit is an example of a reasonable assurance, right? And what do we say in audit? That we have checked the financial statements and everything is fine. Now, if I am saying that I have checked this financial statement and everything is fine, that means this is a positively worded. This is positively worded. Whereas in limited assurance, this is negatively worded. We'll see what in what situations do we give a limited assurance going forward in the course. Okay. So two types of assurance: reasonable assurance and limited assurance. Reasonable assurance is positively worded. Limited assurance is negatively worded. Now, in reasonable assurance, I say that I have checked this and it is as per the FRF. That means I'm saying it is correct. This is a positively worded. But how will I frame a negatively worded statement? Pay attention, guys. Pay attention. This is very important. If I say everything, I have checked this, everything is correct, this is a positive statement. But if I say nothing has come to my attention, be very careful, guys, be very attentive here. Nothing has come to my attention which causes me to believe. Nothing has come to my attention which causes me to believe that the financial statements are incorrect. Is this a positive statement? No, I am just saving myself. Practically, what's happening? I am just saving myself. I am saying I am not aware of any situation which causes me to believe that the financial statements are incorrect. I am not saying that these are correct. Can you make out the difference, guys? I am not saying that this is correct, that the financial statements are correct. I am just saying that nothing has come to my attention which will cause me to believe that these are incorrect. All right, so this is a negatively worded statement. So limited assurance gives a negatively worded statement. Now, if I ask you which of the two will give you a high level of assurance, positively worded or negatively worded? It's the positively worded, right? Of course. This gives us high level of assurance. This gives me a high level of assurance. And I've already told you that audit is an example of a reasonable assurance. All right, so audit is an example of a reasonable assurance. Now, guys, I hope till now everything is good enough, right? I hope this thing is clear. Okay, now let's switch to the manual ones and see if we have missed something to be covered till this point. Let me show you the manual as well. Now, so this is the first chapter. We have covered what is assurance, and if you notice, we have done this definition, right, in which a practitioner obtains sufficient and appropriate evidence. Why? Because they have to express a conclusion, and this will enhance the degree of confidence of intended users. Okay, then we have done this five elements. This is very important, guys. There are five elements of assurance, and when I say this is very important, I do mean that this is Very, very important. Okay. So three party involvement, subject matter, suitable criteria, evidence, and written report. Okay. Now, so this illustrations is for your reading, guys. You will be in a better position in terms of understanding the concepts. Okay. Now, reasonable assurance and limited assurance engagement. This also we have covered that the practice. Okay, reasonable. It's a positively worded assurance opinion, and limited assurance gives a negatively worded conclusion, right? And since reasonable is a positively worded, it gives me a high level of assurance, while limited gives me a moderate or lower level of assurance, right? And just look at the statement, guys. Just look at the statement. In reasonable assurance, what do we say? In our opinion, the financial statements give a true and fair view of the financial position as at this date and of its financial performance and cash flows for the year, right? We are giving a positively statement. In our opinion, the financial statements give a true and fair, right? So we'll talk about true and fair in a while. While in limited assurance, we say nothing has come to our attention that causes us to believe that the financial statements are not prepared in accordance with FRF, right? Now, let's go back. Let me go back once. Now, if I talk about audit, if I talk about audit, audit has two parts: external audit, external audit, and internal audit. If I talk about shareholders, bankers, customers, lenders, which audit will be there? External audit. These parties are external to the company, right? Internal audit will cover it when we go forward. So to be covered in the course ahead. Now, external audit. When I'm conducting an external audit, when will I say that my financial statements are correct? When the financial statements which are prepared by the auditor, yes or no? No, which are prepared by the management. The financial statements which are prepared by the management, those financial statements give a true and fair view. They give a true and fair view. What do we mean by true and fair view? That means if revenue is 1,000, it is 1,000 only in the financial statements also, right? Just to give you an example, right? It shows a true and a fair view of the items in the financial statements, right? So external audit deals with the financial statements giving a true and fair view and prepared in accordance with prepared in accordance with the applicable FRF, prepared in accordance with the applicable FRF, financial reporting framework. All right. So that's it. What is the purpose? Now I have explained this to you that they give a true and fair view and in accordance with financial reporting framework. Now, what are the objectives of auditor? This also we have covered. We have covered everything, but just reading now. What are the objectives of the auditor? The objectives of the auditor are to obtain reasonable assurance, right? Of course, auditor needs to obtain a reasonable assurance about whether the financial statements as a whole are free from material misstatements. Guys, material misstatement. You are not comfortable with this term as of now. I understand. You are not comfortable with this term as of now. I understand. As of now, let's call it errors. Let's call it errors or mistakes. Let's call it mistakes, right? Obtain reasonable assurance whether whether the financial statements are as a whole, that means in entirety as a whole, are free from material misstatements, free from mistakes, whether those mistakes are due to fraud happening or some clerical errors, right? So obtain reasonable assurance about whether the financial statements are free from material misstatements. Then, what is the next objective? That auditor needs to express an opinion on whether the financial statements are prepared as per the FRF, right? So in the first one, you are you are obtaining a reasonable assurance that there are no mistakes. Then, were they prepared as per the FRF? And then your objective is to report and communicate your conclusion, right? So these are some objectives of the auditor. Now, what is the need for audit? I don't know if you might have wondered this question as of now. Did this question occur your mind? That fine, Ayush, I understand what is audit now. I understand reasonable assurance. I understand that there are some intended users. The company gets the audit done. I've heard this a lot. But I fail to understand that why is the need for the audit? Why do you actually need to have your financial statements audited? Can you please explain it to me? My pleasure. Guys, understand. I will talk about, let me talk about shareholders. Shareholders. Now, who are the owners of the company? The shareholders, right? Go back to your academics. Who are the owners of the company? The shareholders. Now, are these shareholders managing the day-to-day operations of the company? Yes or no? No, right? Who is saying yes? Nobody should have said yes. The shareholders do not take on the day-to-day operations of the company, right? If you today purchase a share of McDonald's, you can't go to the management and say, step aside, guys. I have bought a share on McDonald's. I am the owner. I will start managing. I will start giving you the orders. Will you do that? No, right? So the shareholders are not directly involved. We understand that, right? The shareholders are not directly involved in the operations. So if shareholders are not involved, who is involved? The board of directors or the management, right? They are involved. Now, since they are involved in the day-to-day working, they are in a position to manipulate the financials. They might manipulate. Now, some of you out there might be very sweet. I'm sure all of you are, but some of you might be extra sweet towards the management. And you are now having a question that why will a management manipulate? I'll tell you why. Because they want investors to invest in their company. They want to impress you as a shareholder. If the revenue in the previous year was, let's say, 100, and if the revenue this year has grown, then only you will try and you will be investing in that company. If the revenue has declined, let's say earlier it was 100, now it is 50, that's a 50% decline. Will you invest in the company which is losing on revenues? No, right? You might want to stay a little longer, hold on to your decision, check the next year's statements, and then probably you'll decide, right? So the management, if it's not audited, they'll say, all right, I have achieved 130. Earlier it was $100. Now I have done 130 of revenue. That's a 30% increase, and you are very happy. You invest in that company. But ultimately, what was happening in the company? The revenues were declining, right? It was a false picture that the management showed you. So they might manipulate it for the investors, for the bank. They need a loan. They want to show a very nice picture to get that loan, right? Then creditors. They want their creditors to be confident. They want to have that credit period. So they might manipulate. So since the management is in a position to manipulate the financial statements, there is a need for audit, right? So that is the reason why there is a so much stress upon the financial statements being audited. Switching back. All right, so that's what I have explained you, that the shareholders, they provide the finance, but they're not involved in the day-to-day working. Who is involved? The directors manage the company on behalf of the shareholders. And of course, they must prepare the financial statements and they might manipulate those financial statements. All right. So hence the need for the audit. Now, if you are doing the audit, what are the benefits? Can you think of some benefits? So there is a mnemonic in front of you. Hired. Benefits hired. Limitations fired. All right. So let's read on. Benefits of the audit. You get a higher quality information, which is more reliable. Of course, since there is an independent auditor who's reviewing the financial statements, independent scrutiny happens, and the results might be valuable to the management. If the auditor finds out that there is some error, there is some fraud happening in the company, it's good for the management to know, right? It will reduce the risk of management bias, fraud, and error, right? Since the audit may detect those frauds, it enhances the credibility of financial statements. We've done that. And the deficiencies in the internal control system. Guys, you haven't read this word. Internal control system. This will be covered later on. To be covered later. So there is some internal control system in every company, right? So if there's a deficiency in those internal control systems in the company, that might also be highlighted with audit. Okay. Now, there is something known as an expectation gap. Now, expectation gap is basically what I think that auditor does and what actually an auditor does. Right? That is an expectation gap. For example, it is a belief that auditor tests all the transactions in the company, but I'll tell you that they test only on sample basis. It's not possible for me. Let's take an example. Amazon, yeah, that's a huge company, right? And the revenue is will be a very voluminous revenue. It will have a lot of transactions. As an auditor, it might not be possible for me to 100% test the revenue, right? There might be billions of revenue entries. And can I, as an auditor, check billions of entries? No, I will be doing on a sample basis. Okay. Then it is a belief that auditors are required to detect all the frauds. And I'm very sure you might be thinking the same till now, that auditors need to detect all the frauds, but that's not happening, right? Auditors are basically required to provide only a reasonable assurance that the financial statements are correct, right? When we go forward, you'll see that it is not possible for the auditor to find out every fraud in the company, right? And it is a belief that auditors are preparing the financial statements, but in turn, it is the responsibility of the management. All right, so these are some expectation gaps. Now, the limitations of audit. What mnemonic did I tell you? Fired. Benefits hired, limitations fired. Now, what are the limitations? The financial statements include some subjective estimates and other matters which might be judgmental. Let's say management might feel that 5% provision for doubtful debts is fine, while auditor might feel 7% should be the number, right? So it involves some estimates and judgments. Internal controls may be relied on. Again, guys, there are some internal controls in the company, and generally, there are situations when you tend to place some reliance on those internal controls. Okay, then representations from the management may have to be relied upon. You sometimes will also rely on what the management is saying, but that again can be a problem. Then, evidence is often persuasive and not conclusive. Why? Because 100% verification is not happening. Because 100% verification is not happening. And hence, the evidence is not conclusive evidence. It is only a persuasive evidence. Okay. And lastly, the auditors do not test all the transactions, they do it only on a sample basis. Okay. Now, review engagements. So, audit is an example of reasonable assurance, while review is an example of a limited assurance. All right. Review is an example of limited assurance. Now, we'll talk about how do you conduct the reviews later on, right? So, you don't need to be bothered about it. Right, so and that's a negatively worded thing, right? We understand that you are just giving a review, and when you are giving a review you will say that, boss, nothing has come to my attention which causes me to believe that there is some problem. Okay, now a review engagement is voluntary. Now there are some analytical procedures that you do and some inquiries that you conduct, right? So analytical procedure is basically, you can take an example, ratios. You compute and analyze certain ratios that, okay, gross margin in the previous year was, let's say, 40%. In this year, it's 15%. My God, that cannot happen, right? There is some problem in the company. There is some error. Something is not correct, right? And then you give a negative assurance report, right? So please give it a reading, guys. I cannot read every word in this textbook. All right, so please give it a good reading. Now, okay, yes, there is a very, very important concept here that we need to cover, that since the board of directors or the management are managing the operations on behalf, they are managing the operations on behalf of the shareholders. Hence, they are known as the stewards. They are known as the stewards. Now, who is the steward? Who takes good care, who takes good care of the resources. And the directors, since they are acting as stewards, they enjoy a fiduciary relationship. They enjoy a fiduciary relationship in the company. All So that is what it is covered in this box. Please give it a reading. Stewardship concept, we have done. Examples of stakeholders, we have done. And guys, we are done with this chapter. We'll just do the MCQs and then we are thorough. I hope with this chapter, you are at least comfortable and you have started to understand some concepts into your audit journeys.